Welcome to TalkTickers, your shortcut to understanding today's crucial earnings calls.
Today we're jumping into the latest numbers from Funko.
And it's quite a mix. The headline numbers look okay at first glance. Net sales hit $191 million, right in line with guidance.
Yeah, and their adjusted EBITDA, though negative at $5 million, actually came in better than expected.
But, and this is the big but, they've pulled their full year 2025 outlook completely.
That's the real story here. Despite meeting Q1 expectations, they're citing, a rapidly changing macro environment and just huge uncertainty around global tariffs.
So it sounds like the outside world, the economy, the tariffs is really throwing a wrench in their plans, more than they maybe anticipated.
Exactly. It suggests the external pressures are just becoming too volatile to reliably forecast the full year.
Makes sense. But they didn't sound like they were ditching their core strategy, did they? They seemed pretty clear that the underlying plan is still sound.
No, they definitely emphasize that. They talked about focusing on discipline, speed, and making real-time adjustments. Being flexible, essentially.
And they highlighted international as a real strength, right?
Absolutely. They pointed out they're gaining market share overseas and really outperforming the broader toy market, especially in Europe's big G5 markets.
G5?
Yeah, the 5 largest European economies. Their point of sale growth there was like 8%, while the overall market was only up 1%. That's a significant gap.
Okay, so Europe's a bright spot, and they're doubling down on that international focus with physical stores, too.
Yes, exactly. New licensed and partner stores are opening in the UAE, China, and the Philippines, which is actually their first store in Southeast Asia.
Interesting. So expanding the physical footprint globally, but back in the U.S., things sound, well, tougher.
Definitely. They said the pressure from tariffs and maybe consumers being a bit more selective, that really intensified in Q2.
And the tariff situation seems to have triggered some immediate action. What did they do?
Well, right after new tariffs were announced back on April 2nd, they apparently talked to their retail customers immediately.
And
they paused most of the U.S.-bound orders coming from China for their direct import partners. Basically hit the brakes to figure things out collaboratively.
Wow. Pausing orders is a pretty big step. Shows how serious they view this. What's the longer-term plan for dealing with these tariffs, then?
It's all about diversifying the supply chain and doing it fast.
Yeah.
They're accelerating the move of manufacturing away from China.
To where mainly?
Primarily Vietnam and Cambodia. The goal now is pretty aggressive. Reduce the U.S.-bound stuff made in China from about a third down to roughly 5% by the end of this year.
5% by year end. That's a huge shift. Way faster than they originally planned, I bet.
Much faster. And to manage all this, they've actually set up a dedicated internal team.
Oh, yeah.
A cross-functional tariff task force launched in April. Their job is basically to protect margins, keep cash healthy, and find cost savings wherever they can.
Sounds like cost cutting is a major theme overall, not just related to tariffs.
For sure. They mentioned a global workforce reduction, aiming for over 20% cut throughout 2025. Said most of that's already happened.
20% is significant. Anything else on the cost front?
Yep. They renegotiated ocean freight rates, locked in 100% of them, apparently. And they're doing a SKU rationalization.
Meaning cutting back on products.
Essentially, yeah. Getting rid of lower margin items to focus on the stuff that makes them more money. Makes sense in this environment.
Okay, so cutting costs, shifting production. What about prices? With tariffs going up, are we going to see Funko Pops get more expensive?
Well, this is interesting. They did have price changes planned anyway, part of a 2025 product repositioning. Those are still happening in July.
But not extra increases because of tariffs.
Apparently not. They specifically said they're choosing to maintain those planned price levels, even with the tariff hit. The stated reason is prioritizing fan accessibility.
So absorbing some of the costs themselves to keep fans happy, are they doing anything else to justify the price point?
Yeah, they stress they're continuing to invest in the product itself, better sculpts, quality, packaging, even authentication, enhancing the value,
And they feel this approach is working with retailers.
They think so. They mentioned the collaboration on tariff mitigation has actually made those retail relationships stronger. And the direct-to-consumer side remains important, too.
How's that DTC business doing?
It's holding steady as a percentage of sales, around 22%. They highlighted their loyalty program, Fan Rewards, saying it drives strong engagement, repeat purchases, that kind of thing.
Good. Did they call out any specific product areas that are performing particularly well?
They did, actually. Sports. They see that as a big growth area, Mentioned successful launches around the NBA, MLB, NFL, WNBA. Seems like sports collectibles are hot right now.
Okay, let's circle back to the Q1 numbers themselves. We know sales and EBITDA, but what else? Gross margin?
Gross margin was solid at 40.3%, gross profit of $76.9 million. Their operating expenses, SG&A, came in below their guidance at $84.8 million.
Which helped the bottom line, presumably.
Right. The adjusted net loss was $17.8 million, or 33 cents a share, which was better than they'd forecast. And that negative $4.7 million adjusted EBITDA also beat their internal target.
So Q1 wasn't a disaster operationally, despite the clouds gathering. How does the balance sheet look? Cash, debt.
Cash ended Q1 at $25.9 million. Total debt ticked up a bit to $22.2 million.
Inventory. That's always key for Funko.
Inventory actually came down, which is good.
Yeah.
Net inventory at $87.7 million. But overall liquidity dipped slightly to $90.9 million.
Okay. And just to be crystal clear on the guidance withdrawal, the main drivers again were
ongoing tariff policy changes and just the general macroeconomic uncertainty. Too unpredictable, basically.
And they gave some color on Q2, expecting a negative impact.
Yeah, they expect Q2 results to be hit by both the direct tariff costs and the sales disruption from pausing those China direct import orders we talked about.
Now, there's also some important language in their official filings, the 10Q.
Yes, the going concern language. It's important context. They stated they're currently compliant with their debt covenants and have enough liquidity now.
Right.
But they've started talks with their lenders about potentially getting some covenant relief for Q2. And they're also looking at refinancing options for their debt.
So for now, they're proactively addressing potential future pressure. That going concern disclosure is definitely something investors need to watch.
Absolutely. It signals potential risk down the road if things don't improve as they hope.
Speaking of hope, management did express some optimism for the second half of the year, didn't they? What's driving that?
They believe their mitigation efforts, the sourcing shifts, the price changes already planned, the cost cuts will fully offset the estimated $45 million hit from tariffs at current rates.
So they think they can neutralize the tariff impact by H2?
That's the plan. They also expect to get those direct import shipments from China back up and running in the U.S. and for the international business to keep growing strongly.
So the message is, tough times now, but we have a plan and we think it'll work.
Pretty much. They reiterated confidence, talked about stronger partnerships, sharper focus, faster action. They also mentioned retailers seem okay with the planned price bump for Pops to $14.99, seeing it as good value still.
Any signs of life in the U.S. market recently?
Actually, yes. They pointed to an encouraging trend in U.S. point-of-sale data. It apparently went from mid-single-digit declines earlier in the year to low single-digit growth in the last 4 weeks before the call.
Okay, a glimmer of hope there. And that strong Q1 gross margin, what was behind that beat?
A mix of things, apparently. Slight improvements in product margins, inventory reserves, less discounting. They also said tariffs had minimal impact in Q1 itself.
Right, the pain is more Q2 onwards. And the headcount reductions will help margins later.
Yes, those savings will start kicking in during Q2 and build through the rest of 2025.
Okay, so pulling it all together for listeners, trying to make sense of Funko right now. Key takeaways.
Well, first, the guidance withdrawal is huge. Signals major uncertainty and the real bite tariffs are taking.
But the international growth is a definite positive counterbalance.
Definitely. And management is being very aggressive on costs. And the supply chain shift, you have to give them credit for moving fast, even if it's out of necessity.
The going concern language, though, that's a flag. Need to watch the debt and refinancing situation closely.
Absolutely critical. And finally, that recent uptick in U.S. sales is nice to see, but the overall consumer environment is still a big question mark.
All right, let's shift gears to our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas based on all this. What's cooking?
Okay, first idea, playing on that international strength we keep mentioning. Outrageous but plausible trade idea 1. How about a paired trade? Go long a basket of publicly traded European toy retailers and short a basket of U.S.-focused toy retailers.
Interesting. Betting on the divergence.
Exactly. The idea is Funko's strong European POS growth benefits those retailers, while U.S. retailers face more tariff and consumer headwinds. Leverages Funko's regional performance difference.
Okay, a geographic arbitrage play, essentially.
Yeah.
Got another one.
Yep. Outrageous but plausible trade idea 2. This is maybe a bit more indirect. Consider going long on the shipping companies that specialize in the routes between Vietnam, Cambodia, and the U.S.
Betting on the supply chain shift itself.
Precisely. If Funko really pulls off moving that much production that quickly, those specific shipping lanes could see a significant bump in demand. It's a bet on the infrastructure supporting Funko's pivot.
Definitely thinking outside the usual Funko box there. Okay, that wraps up our deep dive into Funko's latest earnings call.
We've hit the key results, the major tariff impact, and how management's trying to navigate it all.
And just one more time, those trade ideas. Purely speculative brainstorming, definitely not financial advice. Always do your own research.
So what do you think about Funko's strategy? Can they pull off this pivot? We'd love to hear your thoughts. Join the conversation.